Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for July 26th of 2021. Please see our disclaimer for important information. Well, as we get started this week in the news you can use, I thought I'd put up a quick slide on the coronavirus because of the rise of the Delta variant here in the States and actually worldwide. And it's been interesting, certainly occupied a lot of conversation, increased fears of what might happen as a result of this, although I don't think anybody really expects the world to shut down again. That's clearly not in any of the conversations that are out there in the public mainstream, but it has had a little bit of an impact on sentiment and on retail sales, as we'll see in a minute. But I thought I'd put this up there because it is hard data. On the left-hand side, the trend line, you can see it slopes down and to the right. And that just represents that the states that have greater concentrations of vaccinated people are tending to have definite lower rates of deaths per million residents. And, it's not, it's fairly intuitive. We've been listening to the data that says that the people that are getting sick and that certainly the people that unfortunately are dying from COVID are essentially 98, 99% unvaccinated people. So, and this is the data behind that. So that trend line shows you that infection rates and deaths are very much tied to the vaccination rate. On the right-hand side, I thought I'd put this in there, maybe a little hard to read, but it gives you breakdown by different geographic locations in Chile, Brazil, Australia, India, and then the UK and the US. And what's clear is that with all the conversation about this Delta variant, it's not the only variant out there. And so I think this kind of goes back to that argument and this kind of renewed push by some of the anti-vaxxers that are now pushing people to get vaccinated, that this is proven to be a very crafty virus. And so you can see, you can kind of bone up on your Greek alphabet here, but there are a lot of different variants and not just this Delta variant. There's Epsilon, Beta, Gamma, Kappa, Lambda. Lambda is an emerging strain that is in South America. But anyway, not to dwell too much on this, just to say that, listen, there are different variants of this. So it's not just one that we're dealing with across the world. Here's our high frequency data. For the most part, continues to be good, steady Eddie, I'd say. Box office, we've had some new releases, so those numbers are very good, as one would expect. But we've seen a little bit of drop off in rail car traffic, a little near-term noise. That number's been fairly good. Steel production is good. Hotel occupancy, I mean, we've got a couple of slides on high frequency categories that are looking really good right now. TSA checkpoint data, people are traveling this summer and they're driving also. So the supply of motor gasoline and gasoline sales are up for the most part, and then flights are up as well. So we continue to see a little bit of positive trend in the labor market. I think we're kind of settling in right now with where we are in jobless claims, but the numbers have been pretty reasonable over the last several months. Here's a quick check-in on retail sales, and in one particular category that just got bludgeoned in the pandemic, and that was clothing and accessory stores. And this is sales in store, and we've now reattained our prior levels pre-pandemic, which is actually pretty remarkable. So in some sense, this is good because people are out and in the stores shopping, and they're going back to a category that, as I said, just got really beat up during the pandemic. A couple of charts here, one from data from the Bureau of Economic Advisors here as reprinted by Deutsche Bank and Haver Analytics on the goods spending. We've had a really strong surge in goods spending. We know that. A lot of durable goods, people looking for new washing machines and TVs and exercise equipment and things like that. Goods purchases have been exceptionally strong. And so This is a chart that indicates as we look ahead into the coming year, year and a half here, that those trends are likely to remain higher, but to moderate somewhat. And I think, by this chart, this is the trend line. That dotted orange line represents the pre-COVID trend line. And I think we kind of eventually migrate back to that over the next 18 months, but still remaining at a fairly acceptable and reasonable pace, and absolutely a positive pace. Now, if you transition over to the right and work, again, by Deutsche Bank here and the BEA, you can see the services spending, and that has been below trend. Of course, we've had gradual reopenings, and we've had fits and starts, and we've had surges in the coronavirus that have prompted some pains in some of these establishments to reopen restaurants, even cleaners and other retail type operations. And so we are expected to get back to the pre-COVID trend about the same time that we begin to kind of reattain those pre-COVID trends over on the goods side as well. Here's a weekly retail sales trend. And again, this is going to reflect the what we've seen here lately with this Delta variant. So, and you look over on the right-hand side, you've got the Consumer Comfort Index, and that's kind of peeled off a little bit here over in the last month, just as we've seen, more people, talk about the Delta variant. If you go into a supermarket, you're going to see more people wearing masks. My local supermarket, I would probably guesstimate somewhere between 30 and 40% of all the people in the store are now wearing masks. And this is just to, prevent the spread. If they are vaccinated, then they're, keeping it from, transmitting it. They may unwittingly have it, and, they don't want to transmit it. But mask wearing is picking up in areas, and it is giving some people pause on sentiment. And I think it's translating a little bit into retail sales as well. And you can see that here on the left-hand side, and the Consumer Comfort Index, you can see, is impacted similarly as well. Again, above these levels of the pandemic, but just off their peaks here on an interim basis. Here's a couple more items related to high frequency. On the upper left, you've got the airline sales survey. We're adding more flights to the inventory, and those flights are getting full. And so we're seeing the trend lines in airline capacity move in a positive direction. We're not there yet, but you can see that this trend line is moving fairly aggressively back up to pre-pandemic levels. Now, on the other two charts, the one down at the bottom gives you an indication where our hospitality sector is. And again, another area that was just absolutely bludgeoned last year. And where we are now is in an uptrend. It's positive. We're getting occupancy levels that are moving higher. Now, the only choke point in a lot of these service areas is just finding enough labor. And so some of these hotels, frankly, are operating at less capacity than they otherwise would, or less capacity than demand would otherwise dictate, simply because they don't have the manpower to either clean rooms or what have you. But in any case, occupancy is moving higher. RevPAR, which is revenue per average room, is moving higher as well. And then you can see that data kind of reflected also on a more of a near-term basis. The chart at the lower left kind of goes back in a longer time frame than we have on the chart on the right. But you can see trends in RevPAR occupancy, relative to the 2019 averages. I mean, we're basically back where we were, which is a remarkable comeback for this industry. Here's some data. We're going to get into housing just as an update. Really interesting trends here. Existing home sales have had, fits and starts, and even though this number was below expectations, if you look at it relative to the last half decade, if you will, even back to 2014, these existing home sales are really positive. And year to date, existing home sales in millions. If you look at this very well-established trend line in the lower left, we're actually moving ahead of that. And we're above that trend line over about the last 6-7 years. Now, if you look at inventory, that is a pretty well understood issue right now, that there's just none out there. And you can see that heavy blue line relative to the last 6-7 years, and it's well below that, as well as month supply. We know that it's tight, and of course that's creating a headwind for would-be buyers because prices are moving higher. And here's a quick note on those prices. So we've got several data points here. We've got the National Home Price Appreciation Index for June. This is produced by the American Enterprise Institute. By their measure, home prices are up about 16%, and up from about 15% a month ago. Actually, not much of a change. And then we were up 6.5% a year ago. So 6.5% home price appreciation in any year is actually pretty phenomenal. And to have, essentially 2.5 times that in this particular year is pretty outrageous, as a matter of fact. And you can see down below that a lot of this is coming at the kind of the medium price point as well as high price point levels. On the right-hand side is a well-established national index, the Case-Shiller index, the National Home Price Index. And you can see that that is overlaid against Zillow's Home Price Index, which is produced by Zillow, of course, but you can see that there's a really tight relationship there. And you can see where both of these are moving. Here's a quick look at something I thought was pretty interesting from the Daily Shot, a ratio of U.S. house prices to median annual wages. And again, this is one of the inputs into housing affordability. And this is one reason why it's challenging for a lot of families, especially at the starter home level. First-time home buyers are increasingly having trouble, even though credit is becoming a little bit easy. But just, the price points and being able to fund down payments and things like that are becoming harder. So by this chart, it looks like, we're clearly moving higher in house prices relative to annual wages. So it's becoming harder for someone to be able to afford a house on one's, own individual income. And in a lot of cases, they're going to need, help, and they're certainly going to need cash. And just, I thought it was interesting because it's not quite up to 2006 levels, where we saw a lot of profligate and indiscriminate lending on the part of banks. We are seeing increasing credit standards, loosening credit standards right now. But where we are in terms of price to income is not nearly as high as where we were in 2006. Here's a quick look at our 30-year fixed mortgage. Now, we were trending higher at the beginning of the year. We knew that that was going to begin to be a headwind as we started to talk about inflation. But what's interesting here, with this notion that maybe inflation is a little bit transitory, that these rates have dropped again. And this is, kind of an interesting phenomenon here. And so what's happening is the 10-year Treasury is rolling off, and the 30-year fixed mortgage rate, which is indexed to the 10-year U.S. Treasury, is falling off in tandem with that. And so where we are now is, essentially about 2.75 to 2.8, and we've taken a really strong drop off here in the last week or so as 10-year Treasury yields have really dropped off a cliff. Quick look at manufacturing, and so in recent weeks we've looked at the Empire State, we've looked at the Philly Fed. Those are Federal Reserve districts, and those charts, I believe it was 2 weeks ago we looked at this, and it was like a direct mirror of one another. Now we get to the Kansas City Fed, and we see very similar trends. So this chart, just in terms of the way it's laid out, and this huge spike on the right-hand side, obviously means that manufacturing activity is really strong. But this chart looks very similar to the other ones that I didn't publish this week and from the Kansas City Fed. And that's, production, export orders, backlog, prices paid, delivery times, prices received, average work week, and employment levels all look like this same chart right here. So activity is moving in a big direction, but we have supply chain bottlenecks, and we do have prices that are building within the system that are actually now being passed along. Here's a quick look at that chart that I kind of alluded to in my comments about housing, but this is more of a commercial lending issue, but it's the same for residential as well. But percent of U.S. banks that are easing their lending standards, and you can see that that number is really moving higher. Again, we're actually close to levels that we saw, before the global financial crisis. Again, I don't think we're in the same league with liar loans and no verification kind of things that we had. It was just profligate and indiscriminate and actually negligent lending on the part of many institutions. I don't think we're there. It's just lending standards have really eased, and so credit has become a lot easier for commercial real estate, for C&I or commercial and industrial loans, for commercial enterprises, as well as mortgage loans, consumer loans. This is a broad composite, so credit becoming easier. But what's interesting here on the right-hand side, you can see at least from a commercial perspective, we had a big spike. You see that loans and lease number, and it really spiked during the pandemic. That was a lot of the commercial entities drawing down their lines of credit. We were in a pandemic, and so they needed to raise liquidity, so they drew really heavily on their lines of credit. Well, now what's interesting, the dynamic here is, a lot of these commercial entities are flush with liquidity and they don't need to borrow. And so loans and lease volume has really dropped off below that trend line that was established pre-pandemic. So, and that's, this kind of goes, these two charts go hand in hand in the sense that credit standards are easing in some measure because there's not enough, there's not as much loan volume in the pipeline. We'll spend a minute or two here on the commodity price basket. There's interesting things going on here. In the upper left, we've got iron ore that's dropping off its peaks. On the lower left, we've got copper, one of those industrial commodities. And you can see that it's dropping off and it's kind of testing its resistance line here if you basically go back to the pandemic levels. And then on the right-hand side from Oxford Economics is really kind of a forecast, which I think seems to mirror a lot of the groupthink that's out there that, obviously we've had these spikes, we're rolling off the peaks, and that these numbers are going to moderate and attenuate over time. Now, at least in this particular survey, it doesn't appear that aluminum and copper are going to moderate real heavily from current levels, which is kind of consistent with this notion that we're going to likely have some increased levels of inflation relative to where we were before this inflation spike, but they're going to moderate a little bit from their peaks, and we're clearly seeing it already here in the data. Here's a quick look at lumber prices. It's a dramatic chart. A lot of people were really fretting lumber, and I think some people were out hoarding lumber as much as they could, but you can see here that lumber prices have really dropped off a cliff. So those people that were really aggressive in trying to build inventories at the peak, not knowing where it was going to go, were kind of left holding the bag right now. But again, this whole notion that commodity prices were peaked and were clearly expected to kind of roll over, and here, at least in the case of lumber, they've rolled over in major fashion. This is an economic outlook that's produced by Morgan Stanley. So I'm gonna caveat here that this is just one investment bank's estimate. It does seem to be pretty consistent across the board. So if you look at the 2021 base case, which is in the middle there, so real GDP expected to be 7.1%, consumer price inflation 3.3%, unemployment rate 5%, Essentially, we're going to be really close on policy rate, which is essentially the Federal Reserve um, rate, which actually probably will wind up being closer to zero. But then they give a bull and bear case, and then they look at 2022. And what's really interesting in this, and again, it is somewhat consistent with what we're seeing in some of these other large research houses, is that you've got a real GDP, which is going to moderate. Everybody expects that, widely thought. So that's not a shock. But you also have a drop in the consumer price index. Now, in this case, they're looking at 2.3%, which is still above the Fed's 2% target. And they said that they would hold rates steady until that inflation level is sustained at a higher rate than that target. And so this is evidence of that. And so this is very consistent with my own thinking that we're going to have inflation levels that are higher than what we've been accustomed to. And you can see in the 2020 case, it was like essentially 1.2. We didn't have inflation, but here, I think very consistent. And also unemployment. So we dropped the unemployment rate from essentially 5% to 3.9. So, which is getting closer to where we were pre-pandemic. Again, a recovery that's faster than we thought, and it looks like we're going to get much closer to there next year, and I'm sure that will have an influence on all of these discussions with regard to interest rates during the coming months. Here's a quick look at the U.S. dollar. So we've had a rather pronounced downtrend, over a period of time, and we've seen some recent strength. And what's interesting is that real 10-year yields continue to drop more negative. And so with that, we've seen a pretty interesting trend here as of late, with the dollar strengthening just a little bit. Quick look at the dollar index and then gold. There's a strong historical relationship between these two, but as we've seen, changes in the U.S. dollar, we actually see gold prices, continue to move a little bit higher after having corrected a little bit. So with the dollar beginning to increase, we're beginning to see a little bit of activity in gold, which doesn't normally necessarily happen that way. You can see a little bit of a break from trend line here, but dollar stronger, gold a little bit stronger as well. Sentiment. Let's talk about sentiment. So the American Association of Individual Investors, investor sentiment, bullish readings are dropping. So as we're ascending to these high levels and we're showing a little bit of bump in the market, that ratio is dropping off. Also, long-term earnings forecast, we're at a multi-decade high, so that number still remains fairly high. And we've got our S&P 500 trend line that you can see is pretty well established, dating back to last October. And the S&P 500, the number of stocks above their 50-day moving average, which is something we were really monitoring kind of mid to late spring, now that's kind of rolled over. So we've only got essentially about 37% of the S&P 500 where the stocks are trading above their 50-day moving average. And that's, I think, a little bit more healthy than certainly we've seen in recent memory. Here's our guidance rate on S&P 500 earnings from Cornerstone Macro. Companies are still very optimistic, even though we've got these valuations that are kind of sticky, and we have seen a little bit of a sell-off in stocks, but I think it has a lot to do with profit taking. Maybe this investor sentiment with regard to the Delta variant and how that might impact things. But confidence remains high, guidance is being raised. And on the right-hand side, you can see that 12-month rolling repurchase announcements. These are buybacks by companies of their stock in the open market are really surging right now. Here's a quick look at inflation expectations. So And this is from BCA research. And what this indicates is that, we're getting this inflation surge off the bottom, and it's rolling over a little bit. And it looks like, we're going to be above, 2.0%. And in that chart that we showed you from Morgan Stanley, their expectation for 2022 is 2.3%. And that's in line with what this is telling us. Now, BCA is really looking at this from the perspective that inflation needs to be closer to 2.5%. And so by their judgment, this is below that level, but it's still above where we've been, over a longer time frame. And then on the right-hand side, it's clear as we're looking at inflation, and this is where, some of the inflation tea leaves can be misread, is that we've got transport, services, energy, rental cars, so on and so forth, that are really surging right now and influencing that rate. If you go over to food and shelter, the inflation rates there are not that pronounced. So this is where some of this inflation thing might be a little misunderstood. So in the latest estimate, we're looking at a Fed rate increase in March of 2023. And that continues to move up slightly. We're going to hear more rhetoric next month when the Kansas City Fed holds its Jackson Hole Summit. But at least right now, that first rate increase is slotted for May 2023, and then the second one is slotted for October of next year. Of 2023. Here's a quick look at Treasury securities and deposit growth at commercial banks. We've told you that loan volume is a little bit off. So is deposit volume as well. And so the read through on this from Deutsche Bank is that, you're going to have less demand from commercial banks to buy Treasury paper as it's put out in the market. We know that the Fed is a big buyer right now, but they're eventually going to taper those purchases. And so it's going to put more onus on the commercial banking sector and foreign purchasers to soak up that demand. And we sure know that we're going to be issuing a lot of treasuries to fund our deficit. But in this case, what it's telling you is that deposit growth is not moving very aggressively. And so that may limit the ability for commercial banks to be active buyers. And so when you think about, limited capabilities, so there's less demand, prices move lower and yields move higher. So the implication of this is that perhaps this could lead to higher interest rates. So, and we're getting closer to the end here. In fact, this is our last slide, but I wanted to end on this note that the trends that we've seen in online retail have been really remarkable over the last year. And it's interesting that we had a pandemic during a time where a lot of this technology was evolving to make it a lot easier for people to buy remotely. And so this is just a survey from Survada. I'm not familiar with them, but 60% said they expect to continue to more heavily use online purchasing or pickup, or essentially pick up at the curb. And so you can see the numbers here that clearly that trend is well entrenched and is not changing anytime soon. The implications here are obvious, that you've got brick and mortar retail that is going to have to reevaluate itself, or it's going to have to evaluate itself and then probably repurpose a lot of these areas. And I think retailers that have brick and mortar are going to have to think about their square footage and kind of rationalize their footprint, knowing that this trend reflected in this slide is well entrenched and not going away. So I would expect to see more retail centers become almost distribution hubs as well. So it's essentially staging product for pickup as opposed to staging product necessarily for display and for sale. But we'll obviously monitor this. It is a very interesting trend, and I think it's going to lead to probably some interesting evolution in technologies in the online purchase experience that will be fun to watch, frankly. That will do it for this week. On behalf of all my teammates at BKA Wealth, I really appreciate you spending the time here today. I hope you've learned a thing or two. Welcome your feedback, and I hope you have a safe week, a wonderful week, productive week, and we'll see you again soon. Take care.